Money and currency are terms often used interchangeably, but they represent fundamentally different concepts. This distinction holds immense significance, especially in understanding how modern financial systems operate and why honest money, such as gold and silver, continues to play a vital role in preserving wealth. At its core, currency is a medium of exchange that facilitates trade and economic activity. For something to function as currency, it must fulfill several criteria. Medium of exchange, it should enable the transfer of goods and services between parties. The unit of account, currency, allows us to measure the value of goods and services in consistent terms. Portability, it should be easy to carry and transfer. Durability, currency must withstand physical wear and tear. Divisibility, it can be divided into smaller units to allow precise transactions. Fungibility, interchangeability is critical. For example, any $20 bill is equal to another $20 bill. While these properties make currency effective for daily transactions, it lacks one critical feature: the ability to store value over long periods. Money, on the other hand, encompasses all the properties of currency plus the critical function of serving as a store of value. It retains purchasing power over time, providing financial security against inflationary forces. The fundamental issue with currency lies in its inability to store value. Modern fiat currencies are particularly prone to depreciation due to inflation, a phenomenon where the purchasing power of currency decreases over time as prices rise. For example, a loaf of bread costing $1 a decade ago may now cost $3, illustrating the erosion of currency's value. In contrast, true money such as gold and silver retains its purchasing power across generations. Historically, these metals have acted as reliable stores of value, making them indispensable in maintaining financial stability. Gold and silver are often referred to as honest money. Why? Because they possess intrinsic value derived from the effort, time, and resources required to produce them. Unlike fiat currency, which can be created at will, these precious metals must be mined, refined, and processed, an inherently labor-intensive and resource-demanding process. Gold and silver have served humanity as stable stores of value and mediums of exchange for over 5,000 years. From ancient civilizations to modern economies, these metals have retained their significance due to their durability, divisibility, and universal recognition. Even today, gold and silver are considered safe havens during economic uncertainty, unlike fiat currencies, which can lose value overnight due to poor monetary policies or crises. These metals provide a tangible form of wealth preservation. Fiat currencies, by design, lack intrinsic value. They are essentially promissory notes, backed not by tangible assets but by the confidence in governments and central banks. This system allows for the unlimited creation of currency, often referred to as printing money. When new fiat currency enters circulation, it dilutes the purchasing power of the existing supply, a process that can be likened to theft. This creation of currency out of thin air undermines the value of money held by individuals, redistributing wealth to those who receive the newly created currency first, e.g., banks and governments. Gold and silver, on the other hand, cannot be created at will. Their value stems from the labor and resources invested in their extraction and refinement. For this reason, they remain immune to the arbitrary inflationary pressures that plague fiat systems. A crucial distinction in financial analysis is the difference between price and value. Price, the amount of currency required to purchase an asset. Value, the true worth of an asset, determined by its purchasing power relative to other assets. Inflation and eroded value. While the price of an asset may increase, its value can decline. For example, if the price of a house doubles over 10 years due to inflation, but the cost of groceries and fuel quadruples, the house has effectively lost value in terms of purchasing power. This phenomenon highlights the illusory nature of inflationary price increases. Measuring assets against other tangible goods, such as gold or oil, reveals their real value, a practice often overlooked in fiat-dominated economies. All asset classes, real estate, stocks, oil, gold, and others, experience cycles of overvaluation and undervaluation. Understanding these cycles is essential for investors seeking to preserve and grow their wealth. Currently, gold and silver are undervalued relative to other asset classes, making them attractive investments. Historically, periods of undervaluation have preceded significant bull markets in these metals, offering substantial returns to those who recognize the opportunity early. The 1970s provide a compelling example of gold and silver's potential during economic turbulence. Gold's price increased 25 times, while silver surged 41 times during this decade-long bull market. This remarkable growth was fueled by rising inflation and economic instability, which drove investors toward tangible assets. After periods of correction, gold and silver consistently rebound, often exceeding their previous highs. This resilience underscores their status as reliable stores of value in the face of economic uncertainty. Since 2011, gold and silver have been in a mid-cycle correction characterized by price stagnation and minor declines. However, this does not signal the end of their bull market. Instead, it represents a temporary pause in a broader secular trend. The global economy has been heavily manipulated through monetary policies, including excessive money printing and artificially low interest rates. These distortions have created unsustainable bubbles in various asset classes. History suggests that such manipulation inevitably leads to financial crises. As confidence in fiat currencies erodes, gold and silver are poised to reclaim their roles as safe havens, driving significant increases in their value. For those invested in gold and silver, patience is key. The current mid-cycle correction presents an opportunity to accumulate these metals at favorable prices before the next major bull market unfolds. The speaker emphasizes the importance of staying invested through market corrections, likening the process to riding a bull that occasionally bucks. By maintaining discipline and a long-term perspective, investors can position themselves for substantial rewards in the coming years. Given the current economic environment, the speaker expects gold and silver to experience dramatic price increases within the next 1 to 3 years. These gains will likely coincide with a broader financial crisis, highlighting the enduring value of honest money in protecting wealth. The distinction between currency and money is more than academic. It is a critical factor in navigating the complexities of modern finance. While fiat currencies continue to lose value due to inflation and poor monetary policies, gold and silver remain steadfast as honest money, offering stability and protection. By understanding the cycles of asset classes and the historical resilience of gold and silver, investors can make informed decisions to preserve and grow their wealth. As the global economy faces mounting challenges, the time to embrace honest money is now. Gold and silver have proven their worth for millennia, and their role as reliable stores of value will only become more pronounced in the years ahead. For those prepared to act, the rewards could be transformative, ensuring financial security in an uncertain world.